Warren Buffett says, invest in wonderful companies at fair prices and not fair companies at wonderful prices. Most of the time, people like you and I, we are searching for a cheap stock to buy, and we buy penny stocks and we lose our money because the company is not wonderful. It's just that we think the price is fair. So today, I will show you how you can invest in wonderful companies at fair prices, starting at just $1,000 account. Hi, my name is Ben. Welcome to Ben Talks Money. I have an MBA in finance and management, and I've been trading for the past 8 years. Warren Buffett is known for picking exceptional companies, buying their stocks at fair prices and selling them for huge profits. He invested in Apple at an early stage. He invested in Amazon back in the early ages. He always has an eye for investing in wonderful companies, not cheap stocks. He's not looking for cheap stocks. He's looking on the company's fundamentals. That's all he looks at. He doesn't look at a chart and say, oh, the stock is down, so I'm going to buy. And that is the same philosophy that I've been using in building small accounts. And today, I'm going to show you how you can also do the same. So, first of all, you need to build a watch list. Build a watch list of all the big companies, your Amazons, your Apples, Nvidias, your AMDs, your Netflixes, all the big companies, especially the tech companies. And you build a watch list for all of them. And you keep an eye for any drop whenever the company drops or whenever there is macroeconomic event that causes the stock market to drop. You keep an eye on the stocks that are dropping the most. Maybe there's a news that comes in that, affects a specific sector more than the other. You keep an eye on those sectors. Like a few months ago when the tariff news came in, the chip makers, the Nvidias, the AMDs, the Broadcoms, they were affected the most because of the tariffs with China and how, most of their revenue comes from selling chips to other countries. So that sector dropped massively. And in conjunction with the retail sector, your Lululemons and all the other retailers that makes their products from China. But what you have to look at, how you're going to pick which one to invest your $1,000 in, is based on how you think which sector you think is going to recover the fastest, right? If you look at the retail sector, they dropped more than the chip sector, but you can tell that company like Nvidia and AMD, they are going to recover faster than Lululemon because the retail sector is going to take a longer time, right? And the tech sector, they usually recover faster whenever there is a downturn in the stock market. So what you do with your $1,000 is that you look at that sector, in this case, the chip sector, and you look at a stock like SMH. That is the ETF. The SMH is the ETF for the semiconductor sector. And because your funds are limited, you can't just buy Nvidia and buy AMD and buy this and that and that. And also, you don't know, you can't predict what challenges an individual company is going to face in that sense. So the best way to go about is to go with an ETF. So you look at an ETF like SMH, which covers all the semiconductor stocks. So that ETF dropped significantly. And it dropped from almost $300 to $170, right? Almost 50% drop, about 45% drop. So what you do is that there are two ways to play that. What I do is I go with options because it gives me the best opportunity and the best return on my investment. So, and I give myself time. So I will buy, let's say when it got to 170, I will buy a $250 call option on SMH that expires 6 months ahead, right? So I'll buy, if with a $1,000 account, you can probably buy one or two, which is fine, right? Because you are building, you are not chasing anything. You are going at your own pace. So you buy that option, and right now, 3 months later, that stock is back at $300, right? Nvidia is back at all-time highs. AMD almost at all-time highs. Broadcom is at all-time highs. Meanwhile, Lululemon is still lagging. All the retail the retail stocks, with the exception of your Walmart and your Costco's, most of them are all down right now. But the tech stock, the Nasdaq, is at all-time highs right now, right? So with that option that you bought for, I think the $250 of call option at that time that I bought, it was about $500, and right now it's trading at about $6,000, right? So right there, you turn your $500 to $6,000, right? And then after that, when you sell, you come back to that same sector and you look at what companies are lagging, because there are always, some stocks, the premium stocks that always pop up first when there is a turnaround in the stock market. You get your Nvidias and your Amazons and your Microsoft going up first. And then there are the secondary stocks. In this case, AMD. Nvidia got to all-time high and AMD was still up around $120, $130. Right now, AMD is up around $170. So after you sell, you come back to the sector. You analyze the macro conditions that cause the stock to drop, the stock market to drop. In this case, the tariff. You can tell that the market doesn't care about the tariffs anymore. It doesn't matter what news that comes in. The market doesn't care. So you go back and you look at AMD and you look at stock like Marvell, all in the semiconductor industry. And you can tell that Marvell is still about 40% from the all-time highs of $120, $120, $125. Marvell is trading around $77 right now, right? So you go back to those stocks and then you pick your option 6 months ahead and you buy that option. And in the case of AMD, you get about 300% return. So if you invest $500, you get $1,500 profit. So right there, you've gone from $1,000, which you only risk half of it, right? Not even risk, you only invested half of it. So that half that you invested is now at the $6,000 profit that you made from the SMH and the $1,500 that you made from the AMD option, right? So right now your account went from $1,000, right, to $8,500, and then you rinse and repeat. Again, you are looking for exceptional companies at fair prices, not fair companies at exceptional prices. No, because there are still losers in this stock market. If you look at the tech sector, there are still losers. There are still companies which haven't recovered, even though others are hitting all-time high. So you always go for the big ones. That's why you build a watch list of all the big name stocks on the market. If you have a Robinhood account, you can build a watch list on Robinhood. If you can download the CNBC app and you can build a watch list from there. You know, I recommend having the CNBC app because you get the information, you get the news, you know what's going on in the market, you know what's coming up next, you know what data the market is waiting for, you know how it's going to affect the market. So that's how you do it, right? As simple as that, following that Warren Buffett rule. Buy exceptional stocks at fair prices, not fair stocks at exceptional prices. I hope this video helps you, and I hope you can start on looking at exceptional stocks at fair prices and not just trading penny stocks and blowing your account every time like I used to do when I started. And if this helps you, please subscribe to the channel, like the video, share, comment. Let me know what stock is in your watch list. Right now, I'm watching Salesforce, CRM, Accenture, and HubSpot. If you have any stock in your watch list, comment in the comment section and let's talk money. Talk to you later. Bye.